Charitable Solutions. We'll get ready to start the webinar here. I will say, for housekeeping purposes, many of you know we will send out the slides to you either later this afternoon or first thing tomorrow. It likely will be tomorrow because I am going to record this call as well. Hopefully my voice, I think it's doing okay, but I just got off another webinar about 30 minutes ago and ate lunch as fast as I could and be able to get through this one. But certainly you can ask any questions, as you see in your dialog box there, as we go through. I'll do my best to answer some of those questions as appropriate, or I will promise you I will get back to each and every question after the call, especially if it's a very specific question to your organization or your pool. So with that, I'm going to take just a few minutes to introduce you to our firm. Again, Charitable Solutions, LLC, was founded by myself and my partner, Mac Johnston, who's also on the call today, back in January of 2003. So somehow we have made it 7.5 years and been in a very, very odd space in the plan giving world, as many of you know or will after this 3-minute or so introduction. We focus on plan gift risk management, and really in two areas, the non-cash side and the charitable gift annuity side. Interestingly, at least to us, not so much for others, but those are the only two kinds of gifts, non-cash and charitable gift annuities, that can actually cost the charity more, at least theoretically, than the original gift itself. So obviously, from a risk management standpoint, a lot of attention is given to those specific areas, which then means we give a lot of attention in different ways of being able to mitigate risk in both of those areas, either directly or indirectly, and I'll go through a couple ways that we do that. First is the non-cash asset risk management side. We spend maybe 10-15% of our time actually as consultants for charities that are trying to receive complex gifts. So of any kind of gifts possible, we've helped a charity receive a 727 plane, and we've done sculpture, artwork, patents, book royalties. I got a call literally in the last 30 minutes during my, in between my last webinar, on $300,000 of timber. So it's actually a timber deed. So it's everything that we deal with, and in particular, S-Corp stock, any kind of closely held stock, and real estate are our particular specialty. So we help charities receive those directly. To the extent that the charity says, look, we would like to get the gift, but we don't want to be on the chain of title, and or we don't want the complexity or management issues, et cetera, what we would rather do is refer that to another charity. We actually created one back in 2003, at the same time we set up the firm, called the Decami Foundation. And it is a national donor-advised fund, a public charity, that is unique in two ways. One, it only receives non-cash assets. So in 7.5 years, we've not received any cash or any publicly traded securities, mutual funds, any of that. So only non-cash assets. And the other thing that's unique is 31 days after the sale, we must, by policy, grant out all of the net proceeds, less a fee that stays in the Decami Foundation that ranges between 1 and 3%. So it's averaged a little less than 2. The average gift size has been about $1.4 million over the last 7.5 years. So the point is that if a gift were to come up this afternoon that is either complicated, has a real quick turnaround, that's our specialty. It usually takes us about 2 or 3 days to do the whole thing and be ready to accept it in terms of due diligence. But a real quick turnaround or risky, instead of saying no, don't say no, you can look at either community foundations or religious foundations that function in that way, and or the Decami Foundation, which we actually work with a lot of community foundations as well, and about 85 other charities that refer those kinds of gifts to us. So in essence, we are the entity that receives it. We do all the tax acknowledgement, all the management, everything, get it sold, and then on average grant out 98 cents on the dollar 31 days after the sale. We also do CGA investment management, not so much on the CRT side, but on the CGA side, usually for smaller pools, so usually between 0 and 3 million or so in assets. And interestingly, we usually get most of our referrals from financial institutions where those prospective clients don't meet their minimums, or they're looking at some other alternatives from a cost effectiveness perspective. We actually do a lot with exchange-traded funds and index funds, and do the internal management as well to try to keep fees relatively low on those smaller pools. And also, I should say that the Decami Foundation that I mentioned before also can issue gift annuities in 42 states. So it's able to issue the gift annuity. We manage it during the holding period or during the life expectancy, or I'm sorry, life income period. And then 100% of the residuum drops into a donor-advised fund and then is all granted out to the charity the donor was trying to give it to as well. So it functions in very much the same way. I also do charitable life insurance appraisals, so about 140 to 160 of those or so each year. So I'm a qualified appraiser and complete qualified appraisals on those. And also do professional continuing education. So I do between about 50 and 60 presentations a year, primarily to professional advisors, but also to board members, staff, training, et cetera, generally around these areas, and probably 3/4 of this is in the community foundation kind of realm, in particular for public versus private foundations. As an example, a lot on the non-cash side, advanced charitable brain teaser side, gift annuity side, et cetera. So do a fair amount of those. And then obviously what we're going to talk about today, I'm not going to get too deep into this since this is the point of the call, but is charitable gift annuity risk management. By way of background, I think we've written every article that's ever appeared on the topic, and really that started back with an article in 1998 in the Journal of Gift Planning, and I think we've written probably 6 or 7 since then, and really, I will say obsessed, I'll use that word, obsessed in this area since that time. So we spend a lot of our time, probably 1/3 of our time last year, at least 2/3 of our time, looking at pools, identifying where risk issues are, and interestingly, it's usually not where most charities think they are, and then some of the boogeymen they think are in there are really non-issues. But to really understand exactly the dynamics of the pool, the dynamics of the charity in terms of risk tolerance, in terms of characteristics, et cetera, and then to be able to provide very specific recommendations on the pool itself relative to concentrated risks, whether some or all should be, I shouldn't say all, whether some should be reinsured and whether this should be partially reinsured or not. What do you do with the large underwater ones or any underwater ones? Cash flow modeling. We do the reinsurance design and brokerage as well to the extent that that is helpful. So anyway, we basically stress test the entire pools every way you can. We're going to talk about the 12 different dimensions of risk within gift annuity pools. And most of this is run off of an engine that we've developed about 4 years ago called the Life Income Risk Management Analytics Suite, to make it very consulty sounding. And that's really driven off of an actuarial study we did for the Society of Actuaries that included about 35,000 gift annuitants. We'll touch on that during the call today too, as well as a CRT mortality study that was a follow-up a year later, sponsored by SunTrust and Renaissance, where we looked at 5,000 CRTs. And the mortality data and formulas that we use to create the stress tests for the pools themselves are the engine that we use for that process. I think that it's important for the folks on the call, I guess we've got about 50 or so on the call today, to understand is we've now done 112 risk audits, just under $1.9 billion in assets. I think we've done maybe 7 of the top 10 largest pools nationally. So I think 3 of those were over $100 million. And the average one is about 10 to 12 million or so that we look at. The point is that a lot of the observations and recommendations that we'll be going through today are certainly based in our work over the past 13 years in the gift annuity risk space, and certainly last 7 years, because we have been offering this for 7 years, and again have about 112 clients or so just for the risk audit side, and then we also do kind of separate work for about 80 or so on the reinsurance side, which may or may not kind of mix and match. So that's us. That's kind of the weird space that we live in. So let's get right to the talk. Again, this will be sent out after, so no need to take notes. Charitable gift annuity risk management best and worst practices. And here's the agenda. We're going to talk about the CGA market overview, risk management 101 very broadly, talk about risk management worst practices. I know I'm supposed to be optimistic and talk about best practices, but nobody remembers best practices. Everyone remembers worst practices. So obviously the opposite of a worst practice is a best practice, so we'll talk about those. The CGA mortality study that I alluded to before that we did for the Society of Actuaries, and really what the implications are of that for gift annuities and liability management in particular. Next 12 dimensions of CGA risk. You probably didn't know there were that many crazy dimensions with that little wonderful, simple one-page gift annuity contract, but there are 12 dimensions of risk that are generally measurable and to some extent need to be contained as well. The exhaustion frequency and severity, just on average in kind of normal periods. The nasty math of negative compounding, so I'll go through a very quick example of how negative compounding works with these gift annuities. Then I've listed, I think, of the 12, 13 different resources that we have written in this space with links, so you'll be able to go to all of those and have fun reading all of them. Some of them bore me and I wrote them, but the point is some of the stuff needed to be analyzed a bit more thoroughly than perhaps has been historically. And then the 4 things that we do very specifically in this space. So with that, we'll get started. Again, any questions that you have, feel free to answer that. I should have a little bit more time during this talk than some of my others to be able to do that. And as I mentioned, I'm more than happy to be able to answer any of those offline too. So, charitable gift annuity market overview. It is estimated, keyword there, estimated, that there are about $15 to $20 billion in CGAs. There are lots of extrapolations going on to come up with that, but that I think is about right. The ACGA is estimated that there are about 4,000 charities that issue CGAs, so using some extrapolation there, coming up to that 15 to 20 billion or so. Might be a little high, might be a little low, but that's roughly the amount. To put that into some context, there are about 125 billion in charitable remainder trusts. So this still represents about 10-15% relative to charitable remainder trusts, but I think that it's certainly important to know, and many of you do, that the trend for charitable remainder trusts really over the last 10 years has basically been dead flat. I mean, it is just flatlined since the late 90s. Gift annuities, conversely, have been booming. And I know there are a number of national financial institutions on the call today, but at least anecdotally in my conversations with them, they're saying that gift annuities relative to CRTs are running 8, 9, one said about 9.5 to 1. So 9 gift annuities roughly for every 1 CRT they're seeing, and they're saying they may be actually biased a little bit more, leaning a little bit more toward the CRTs even in that. They're booming. The average age for gift annuities in terms of gift annuitants when they first set one up is age 78. That has shot up from 77 back in the 94 and the 99 survey. I'm on the ACGA Research Committee, and many of you know at the conference the new survey will be coming out, and I can't mention anything about it, but lots of interesting data in there, and we certainly know that a lot of charities spend a lot of time putting that data together, and that's certainly very important every 5 years for us to get a window into what's happening within gift annuities nationally. The point, I guess, to back up 1 or 2 is it's an estimated on the gift annuities because, of course, none of that has to be reported anywhere. With CRTs, those wonderful K1s are obviously reported in terms of the tax return. Those are aggregated and uploaded onto the IRS website, and we have just magically accurate numbers from the IRS in terms of exactly the number of CRUTs, the number of CRATs, the number of lead trusts, et cetera, with the assets there. So those are great data sets that exist. Nothing like that even close exists in the gift annuity realm. So that's also why the ACGA survey is so important. I will take maybe just a moment, too, and really encourage you, if you're not members of ACGA, it is a ridiculously small amount for the value that's provided. I want to say $100, $125, some small number. Never mind for the data, never mind for the best practices on the site, obviously the rates, and just general advocacy as well. So I think it's just important to join. I think there are about 1,200 or so ACGA sponsors now, so just something to keep in mind. The average gift, this was as of the 2004 survey. Again, we can't release anything on the 2009 survey until the conference here, but the average gift was about $60,000. That did double. That did shoot up, and there are a couple reasons why that I think are good takeaways for you. First, and good takeaways for me too, frankly. First, when I started in this field in 1993, it was understood, I would say, and certainly taught, that if a donor wanted a fixed payout, a guaranteed fixed payout for life and it was less than, at that time, about $150,000, $200,000, then you would do a gift annuity. That's what you did. It's kind of the poor man's charitable remainder annuity trust. If it was over 150, 200, 250, pick your spot there, but right in that range, you would do a charitable remainder annuity trust. There wasn't a whole lot of thought that would go into it. That's just what you did. And by the late 90s, very interestingly, donors started asking some questions, and advisors started to do more analysis as well. And they started to say, well, let's look at something, let's make up that's $500,000. And let's look at what the maximum suggested payout is for the ACGA. And let's look at what the maximum payout would be for a charitable remainder annuity trust. And in most cases, if you ever do that side-by-side comparison, usually the gift annuity is slightly, and I mean slightly, 2–3% in that range on average, lower than what the CRAT would be. But, of course, the donor is compensated through a higher income tax deduction because the donor is taking a lower payout. So that's okay. It's compensating the donor for a lower payout. But let's go on. Many of these donors are older, again, 78 being the average, and most of them don't walk in your office and say, hey, I'm looking for a gift vehicle that A, I get to pay an attorney $2,000 to set up, or $1,500, or pick your number. B, I get to pick a trustee. C, I have to make sure that they've got the right administrator and the right investment manager. And D, if the whole thing actually runs out of money, I want it to completely stop and I don't get any more checks. They don't want those things. So when they start thinking about a gift annuity that, again, just wonderfully simplistic one-page contract, when they look at that, they say, well, I don't have to pay an attorney to do that. I don't have to hire a trustee, an investment manager, and an administrator. And yes, sometimes you can get one that are all three. Sometimes they bifurcate all of those functions. But at some point, you got to kind of monitor what's going on there. Then next, if the gift were to ever, in this case the trust, if that were to ever exhaust, as they are now, and as you know they are now, at least for CRATs, then our payments stop. And what if we're 92 and we need those payments and they've been direct depositing and they just stop? That's not good. The next really big thing, and certainly most advisors have looked into this, is to be able to say, what about the taxation? And certainly relative to gifts that are funded with long-term capital gain property. As you all know, gift annuities are pushing out, in many cases, a very large chunk of that payment is long-term capital gain. That's good for tax purposes, of course. For a CRAT, in most cases, a big chunk of what's coming out of that is either short-term gain or otherwise any kind of ordinary income. Not so good. So what many started to do is they would say, looking at a gift annuity versus looking at a CRAT, the quote-unquote cost was a 2–3% reduction in the payment, but I got a higher deduction for that. Didn't have to pay $1,500 to $2,000 to set it up. Don't have the quote-unquote hassle of managing these three parties either as one or multiple parties in terms of trustee, investment manager, and administrator. And I lose the default risk as well, and I likely have very good taxation vis-a-vis the CRAT to the extent that it's being funded with long-term gain. That's a big deal. What does that mean? That means the last quarter of last quarter of 2008, so it's been about a year. Weird quarter on about 9,000 levels. But I worked on 6 gifts, a 2 $5 million, a $6 million, an $8 million, a $10 million, and a $12 million. Gift annuities, individual or joint gift annuities. Huge, huge. I know Yale has one, I think, that is 61 million, 58 million, something like that. One person. These things they can be gigantic. So don't fall into the, oh, if it's large, that's CRAT. Certainly look at a CRAT. But looking at gift annuities, too, is what most are doing, and that is, in my view, why they're really, really spiking. They've become very, very popular for the large, large gifts. I've already mentioned that they're the most popular kind of life income gift, certainly now, but I think it's particularly important when you look at residuums. Let me back up for a moment. I had the great honor of serving on the Rates Committee from 2003 until last spring. And there's just an amazing and unfortunate amount of confusion by how rates are constructed. So let me just back up for a moment and make sure this is crystal clear. We use assumptions. All assumptions are wrong. so you know that. That's the first fun thing you start with. But you have to use assumptions. You just have to. There's no other way of doing it. So we assume that each charity under the current environment, current rate schedule, would get 5.25% rate of return, net, gross rate of return, constant. Constant means you get exactly 5.25% return every single year, no matter what. Not 5.4% and then 5.1%. That means constant. Then we assume a 1% expense load for administration, any charges to the pool, obviously any investment fees, etc. So that assumes then a 4.25% net constant number is what is assumed. We then assume that every donor is a female, that she is 2 years younger than her actual age, and then we use the Annuity 2000 table, and actually going a fun step further, using projection scale G as the mortality improvement schedule. The bottom line is we assume that each new person coming in, or they assume when each new person comes in, that if the charity gets 4.25% dead on every single year, and the donor dies the moment she's supposed to die, she doesn't make us mad and live 3 years longer, she dies the moment she's supposed to die, that the charity will have 50% in the future, a 50% residuum. More charities than would like to admit think that that's 50% of the gift today. No, 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 no. 50% in the future. So if a new one came in today for your charitable organization and they did a $100,000 gift annuity, let's just make up, the average life expectancy on a 78-year-old is roughly 14 years. So in 14 years, if you got exactly 4.25% every single year, in 14 years, or in the year 2024, there would be on average 50% left over at the end. So that's $50,000 left over in 2024. Why do I emphasize average? Because you're never, ever, ever going to have the person live, I shouldn't say ever, but almost never, to the moment, to the week that she's supposed to die, number one. Number two, clearly, you're not going to get 4.25% net every single year constant. So that creates the average. Many charities use the term 50% of the current gift. No, 50% in the future, number one. Number two, I've heard charities say, oh, that's a 50% minimum. No, that's 50% on average. And three, the ACGA rate is the maximum suggested rate. So when charities exceed that, they kind of do so at their own risk. That's very important to understand. How do they come up with that 4.25%, or more specifically the 5.25% blended average return? They assume right now a 40% equity allocation. They assume that's going to get 9% each year. They assume a 55% bond allocation, fixed allocation, using the 10-year bond as a proxy for that, 10-year treasury, and then a 5% cash allocation using the 13-week T-bill. Why am I really spending a lot of time with this? Because we've had a number of charities that would say, gosh, our pool, for whatever reason, is not doing real well, or this specific one's doing very poorly, and, well, I don't know what's happening. We've always followed ACGA rates. Well, I don't care if you follow ACGA rates. If you put the whole thing 100% Japanese yen fund, you're rolling the dice here. So the more equity you go, if you did that in the 80s and the 90s, beautiful thing. If you've done it the last 10 years, not so good. The point is you really need to really understand the underlying methodology used to calculate those rates. And then know to the extent that you deviate from that, that creates issues. The other issue, which there's nothing that I could have ever done on the research committee, we debated this a lot, that is we basically have to assume law of large numbers. We have to assume that charities have 20,000 of these things. Because if you've got 5 people, all 5 could easily blow past life expectancy, or all 5 could die early. When you have a small number, it's like flipping a quarter. You can hit heads pretty easy 4 times in a row. But we have to assume obviously larger numbers, number one. And number two, that they're all unrestricted. So we're going to talk about that here too. We have to assume that they're unrestricted. Restricted ones create all kinds of issues that we'll go into. So I think it's just important to start with kind of how those rates are built, what it really means, what it means to the organization. So then when you get back to the average residuums, I said, hey, about 50% on average. And you look at these, and you're like, these are fantastic. 76% in 1994, and some of these are, I think, medians too. 76 and 94, 96 and 99. That's fantastic. That means somebody gave you $100,000 and they lived a life expectancy or longer, doesn't matter, and you'd have 100% of that original gift left over at the time. So you'd have $100,000 then. Let me stop there. And many of you have heard me kind of jump up and down about this a little bit. The average annuitant lives about 14 years. So subtract 14 from 1999. That takes you back to 1985, right? What happened from 1985 to 1999? The biggest, longest bull market run in the history of the world. And I'll say it again. The biggest, longest bull market run in the history of the world. So most of our models show charities actually should have been receiving closer to 130, 140%. Because if they're only getting 100% at the end, think about this mathematically. That just means they were just earning the same amount as what the payout was. So if they got a gift annuity back in 1985 and it was paying out 6%, they would only have to be earning 6% paying that out. So they would earn 6%, pay out 6%, earn 6%, pay out 6%, and so on, so that there's 100% left at the end. They were just paying out their earnings in effect. It's kind of pretty hard to only earn 6% from 1985 to 1999 if you had anything in equity, because the markets were up, I think this is true, on average about 21, 22% a year for that 14-year run. It was a beautiful, beautiful run. The point is that got them up to 96, and many charities, and including some of the software, just kind of automatically bake into these life income projections 100% kind of as the default left at the end. Well, yeah, in 1999, if we have another run, and I so hope we do, of 21% a year for the next 14 years, well, you'll probably hit it. But if you don't, the average, how everything is constructed, is this 50% on average. You can see just in 5 years it dropped heavily from 1999 to 2004. Why? Clearly the 2000 to 2002 bear market. But it actually should not have dropped that fast. It should not have dropped that fast, because what that would have meant is you take 2004 minus 14, that takes you back to 1990. So that's when the people dying in 2004 would have created their gift annuities if they were the average age of 77, 78. So then you would have had a wonderful run until about March 14th, I think that's the date, in 2000, where it peaked. And then you had a really, really bad, what's called tail loss. But even then, you take tail losses all day. What you cannot stand with a gift annuity are early losses. So said another way, if you tell me what the investment return is, especially if it's really high or really low, in the first 24 months, there's almost no way you can sink a gift annuity if you had a big run right out of the gate. It just compounds too much going forward. Conversely, if you come out of the gate like 2008 or 2000, 2001, right out of the gate and go negative and then make a payout into that negative market, there's almost no way to mathematically catch up. So these crazy beasts are hypersensitive to the first 24 to 36 months of investment experience. That basically tells you the rest of the story in terms of how that's going to play out. And then, of course, the worst time then to have written a gift annuity would have been in the late 90s, early 2000s, because as I mentioned, that would be early negative losses successively right out of the gate. But those have not yet, I would say, come home to roost. Because if they did it in 2000 and there was a 14-year life expectancy, then all that should be happening year 2014, 2015. So at least mathematically, those numbers should continue going down until 2014, 2015. They just have to, mathematically, because it would have taken that 2000, 2002 market kind of through the snake, if you will. It's like when a snake eats some small vermin and it works its way through its gullet. As it's working its way through, you're now back to 2000, 2002 would have been right when it kind of ate the varmint. That's the worst time to have been able to do it. So even then, though, let me back up here. I love gift annuities. Gift annuities are fantastic. Even then, let's say it drops to what at least we're showing, that 25, 35% or so residuum. Well, here I'm just showing you that in the late 90s, it was at 96%. So even if it's 20%, let's say it's at 0. Let's just make it up that it's at 0, the average residuum. It won't be that low, but let's just make it up. Well, remember what I said the methodology was built on, 50% on average. What's skewing it is you could not have had a much better market run than the 1990s, which just pushes the average and even just jams it up to 100% on the residuum side. And then you kind of couldn't have a worse run, at least for a long, long, long time, than what's happened since the late 90s to now. So now, even if that run, let's just make up it's at 0, well, you mush the 2 decades together again. Where do you come up? 50%. So basically what's happened is you just had this outlier up run, and now you've had this outlier, hopefully it's an outlier, down run, but you're still basically holding with that original methodology. So I just think it's important to kind of set that into some context. A lot of our clients are saying, oh, these gift annuities, and they're horrible, and we got to get out of the business. The point is you just picked the wrong time to get in. It's almost like if you jumped into the high-tech market in 2000. Well, yeah, bad timing. Worked out really poorly for you. But over time, that stuff will smooth and will provide great gifts, especially as we go through, you manage the risk accordingly. Okay, so what's Risk Management 101? This will be a little bit boring, and I will whip through it. Risk is simply that actual outcomes are worse than expected. So for 5 years, I taught in the risk management department at the graduate school at Georgia State just as an adjunct, and we spent whole semesters going through measuring risk and probability analysis and severity analysis and all kinds of incredibly boring stuff. But really, it comes down to this little one-page slide. So you get the little cheat sheet of the whole semester on one slide. That actual outcomes can be worse than expected. So then the next thing you want to measure is, what's the frequency? How often can you have something bad happen? That's all you're trying to figure out. And then you'd say, okay, so now we know how often it may happen. Well, how bad is it if it happens? So making this up, losing my keys. I lose my keys almost every day. I shouldn't tell you that on a recorded call, but I do. Well, how bad is it? Well, it sucks up about 5 to 10 minutes of my time, and my wife yells at me, and she calls me Magellan because I can't find anything. And then I find my keys. Who cares? No big deal. But if it's something that's otherwise that you said, well, look, this doesn't happen that often, but if it did, that would be really, really, really bad. Well, those are the kinds of things you say, now, wait a minute. That's kind of elevated to a level that we need to manage that specific risk. And there are only four ways to manage risk. Very simple from that context. So once you understand how often it can happen and how bad it would be if it did, then you look at the risk management strategies. The first thing you can say is, we'll retain the risk. And that means is, well, we're basically, in essence, self-insuring. So for my key example, I'm not, no way to insure that anyway, but, I just eat it and it's my time and I get laughed at and whatever, I move on. But the best way to think about retaining risk is what your deductible is. So whether you know it or not, when you have your auto policy as an example, you pick a deductible. And that basically says up to $500, let's say, your deductible, you have to eat. So if something bad happens, you got to pay $500. Then the insurance company comes in and takes over for the rest. And you get to pick. Do you want a $250 deductible? Do you want a $1,000 deductible? You get to pick. And you're supposed to be, you don't do this, everybody picks too low of a deductible, frankly, but what you're supposed to do is to think in your head, well, how much of this could I stomach before it really starts to hurt? And you want to retain as much of that risk as you possibly can. You don't want to insure or transfer away risk to the extent that you can retain it. Said another way, does Bill Gates need any property insurance on any of his cars? No. You can have a bulldozer go over all of his cars every 15 minutes of the day, and he's just whipping that stuff out of petty cash buying his cars. There's no risk to him. Zero. For somebody that has $500 in their bank account, they better not have a $1,000 deductible, because if that happens, they're sunk. So that's how you start to look at, well, what amount can we retain? And then at that point you say, okay, at this level we're comfortable retaining that risk. Now what can we do to reduce risk? What can we do to reduce the frequency of something occurring or the severity? Reducing the risk, as you see my example here, would be stopping smoking. So if you don't smoke, that's good. That reduces the risk of all kinds of health ailments that pop up. Or reducing the ACGA rates, obviously, would be reducing your risk because you would be building up additional surplus within that specific gift annuity right out of the gate. Another way you could have it is using my auto example or car example, would be, let's say that you've got a 16-year-old child, which I pray you don't for all kinds of reasons, but you've got a 16-year-old child that's learning how to drive, and you can send them to a defensive driving course. What is that course really doing? You're trying to reduce the risk or probability of an accident. That's what that's why you're doing that, so that somebody doesn't get hurt. But then for the car itself, you might have airbags and seat belts and restraint, all those kinds of things, and particular construction of the car from a safety rating, all that kind of stuff. So that is, if the accident does happen, I want to make sure it's not bad. I want to make sure that the severity is reduced. So that's what you're doing through risk reduction. Then you'd say, okay, I've reduced the risk as much as I can for the frequency or the severity. I have also retained as much risk as I possibly can. So now I want to transfer any additional risk generally, either by contract or to an insurance company. So that's kind of how that works. You do it every single day with your health and auto and home and life and disability, all these kinds of things. You should be making kind of the same kind of rational or logical decisions in much the same way. And you could just completely avoid the risk. So back to my car example, you could say, look, I don't want to drive. I'm going to move to a large urban area. I'm going to get on public transit, and I'm getting rid of the car. That's a real easy way of reducing at least my risk of getting in an accident when I'm driving and the severity of it, because I'm not driving anyway. Now, a cab may run me off the road, but at least from your risk of you driving. So that's Risk Management 101. Here's the super simple Cliff Notes version that you've already seen on the bottom. Do not risk a lot to gain a little. Don't risk a lot to gain a little. Don't risk more than you can afford to lose, and know the odds. Said another way, understand the probabilities. So that's Risk Management 101. So let's jump right into gift annuities. So I think that at least provides the context of risk management, which now we're going to apply it specifically to gift annuities. Here are the top 10 CGA mistakes that we see. Drives us insane, but we're going to go through all of these 10. I'm going to rant and rave, and then we're going to obviously move on with the talk. First, using money currently. You'd think that charities have figured that out, that they shouldn't do that, but they keep doing it. We had a very good client of ours with a $50 million plus CGA pool that up until late 2008, I think November, September, they were automatically taking 30%. You heard me right, 30% right out of their, right off the top, and sending that out to various programs and agencies, et cetera. That's not pretty. There's nothing good that will happen from that. All of the rates obviously are constructed based on 100% reserving, and that means not $1, not 1 penny is paid out immediately. Using money currently is bad. Stop doing that unless you've got a gigantic reserve, which basically nobody does. Second, granting rate exceptions. That's code for offering a higher rate than the ACGA maximum rate schedule. And all of our clients, just about almost all, we'll ask the question, have you always followed ACGA rates? And the vast majority of the time, the clients will say, and I've got a bunch on the call today, so hello clients, a lot will say, well, we almost never offer higher than ACGA rates. Well, what's the key qualifier in there? Almost. And we'll say, whoa, no, you said almost never. What does that mean exactly? Oh, a handful of times we've probably over the years offered, and there's always like the staff person that's no longer there is the one that gets all the blame, and that's good risk management from a personal and career standpoint, I'm well aware. So you basically say, hey, we offered some of these higher rates at some point in the time, but what's the big deal? Here's the big deal. The big deal is you never offer higher rates or a rate exception on the small ones. You're not doing that on a $50,000 or $30,000 one on a 55-year-old deferred male. You're doing the rate exceptions on the big ones. So the $500,000 one, the million one, the $250,000 one, that's where you're doing the rate exceptions. That's a problem because now you're doing a rate exception, which is basically thinning up any reserve you have attributable to that one gift on the largest concentrated risks you have. That's just not good. The other way to think about it, mathematically identical to using money currently. So the same clients will say, oh, no, we never use money currently. But yeah, we do a bunch of rate exceptions. It's the same thing. You're basically using money currently, mathematically, by giving it back to the donor through a higher rate. You're taking any of that surplus that you have and you're shrinking it because the present value of the life income back to the donor, it just went up. It's the same thing mathematically. Bad. Third, thinking a pool is a pool. I need everybody to listen up, big takeaway, lock in on this. Charities always talk about their CGA pools. You have a pool for investment purposes. You have a pool for administrative purposes. We have not come across, I think, only one or two of our 112 clients have a pool for risk purposes. And in particular, if you have restricted funds. What are restricted funds? That means when that annuitant dies, by fund agreement, you wiggle in, figure out the residuum attributable to that dead donor, annuitant, and then you take that money out and you stick it somewhere. You put it in the math department. You put it in a scholarship fund. You send it out as a grant to a beneficiary organization. The key question is could you leave it in the pool if you wanted to and use it to offset other losses and or for a reserve? And if the answer is no, that's a restricted gift. This is key. Even if it's not restricted, but when donors die and you go in and you take that money out, again, annuitants die, you go in and you take that money out and you use that for a specific purpose, you generally also do not have a pool. Now, if it's all unrestricted, there are lots of things you can do, but I think 3 or 4 of our clients out of 112 have had purely unrestricted pools. Why am I making such a big deal about this? This is gigantic. If you are an insurance company, which you are, basically, the second you do one of these, you become a little instant annuity insurance company. If you're an insurance company, you've got millions of these crazy things, and somebody dies 10 minutes after they do an annuity, do you think that insurance company withdraws any portion of that fund? No, not $1. That actuary would look at you like you were crazy. They'd say, well, what do you mean? We knew from a probability standpoint that there'd be some that would die that much early, but we also know from a probability standpoint that there will be some that will live that much longer past life expectancy. So what we have to do is we have to, that's called a mortality gain in essence. We have to capture that mortality gain to subsidize, hold that in the pool as a reserve, to subsidize what we know to be another mortality loss. Do you see what's happening there? You're internally subsidizing. That's what a risk pool does. You can take the gains from one to offset losses of another. You can't do that with a restricted fund pool at all. You cannot do that. Because when somebody dies, you can't hold that in to offset somebody in the future. You have to take that out and put it toward whatever the fund agreement calls you to use the money for. Completely different. So when charities talk about pools, they have a pool for administrative purposes and a pool for investment purposes, not almost never for risk-sharing purposes. What does that mean? What that means is, think about the math of this, that most charities created their pools in the mid to late 90s. So remember I said that it's about 14 years as the average life expectancy. Let's just make up that the average charity created their gift annuity program in 1996. Where would that put them? That means today, in 2010, is when some of their annuitants might start living past life expectancy. Does everybody get what I'm saying here? For the first 14 years, you cannot have a loss no matter what. It's impossible. This thing is a cash cow like you can't believe, because no one has had the opportunity yet to live past life expectancy. So for the first 14 years, you're calling out all of those people that died earlier than expected and using that for the restricted purposes or unrestricted purposes, etc. But what does that leave you with in the pool? What we call very affectionately and lovingly the long-lived dogs. They're the ones living longer than life expectancy. That's where some of the problems are obviously being created in terms of the timing of when these pools were started, quite clearly what's happened in the economic market since then, but you don't have a pool. And especially with restricted funds, I'll beat this horse just one more little whack here. Especially with restricted funds, that means that if the donor dies early, I want everybody to follow along with this. If the donor dies early, the gains inure to the beneficiary organization directly or through a fund. They win. If the donor lives, the annuitants live forever, and it exhausts, let's say, you are the ones, the mothership is the one that is on the hook for continuing to make those payments. You lose. Heads they win, tails you lose. And I hate to say it's an us and them, but that's certainly becoming real clear when some of these things start to get bumpy. So be real careful about the design of the structure of the pool, what things you will allow, what you won't allow, and different ways of being able to manage that risk. Fourth, I've got a whole slide thinking FASB liabilities are reality is a huge, huge mistake. When you look at 106 and 107 under FAS, you're looking at the split interest gift accounting rules. And what most business officers and CFOs do is they say, oh, we've calculated our liability under FASB, and we know what our assets are. So really our reserve is the difference between what our assets are and what our liabilities are calculated under FASB. That's the surplus. That's kind of the net gift, if you will. That's way off. And I'll go through calculations to show you that, unfortunately. And again, I love gift annuities. So at the end of this, I promise you, I promise, you're going to feel very comfortable issuing gift annuities. You're going to do it very confidently, but you're also going to understand what my partner Mac always says, which is perfect, is how to keep the ball in the fairway. Don't go nuts with these things. Don't try to hit the, the driver on every single swing. Keep it in the fairway. When it gets too risky, figure out what to do with it, and we'll tell you some ways of being able to mitigate some of that risk. But just don't go nuts with this stuff. You'll be fine. Fifth, which goes to the nuts part, no asset liability matching on investments. What does that mean? Here's something that always kind of shocks people when I mention it. Some of you may have heard this before. When you look at insurance companies, they're screwed up too. But when you look at insurance companies, they manage millions and millions and millions of immediate annuities for the lifetime of the owner or the annuitant. Same thing you're doing. And if you gave X company $100,000 and say, pay my mother $7,500 a year for life, what would they do with that money? They would take that money and they would go out and they would snap to what her life expectancy is, because they've got millions of people and they got law of large numbers, so they can, oh, it's beautiful. They can just nail it. And then they buy a big bucket of bonds, all kinds of bonds, all fixed income instruments, to exactly guarantee that $7,500 a year for life for my mom. And if she lives too late, that's okay, because their pool is so large, they'll know there'll be enough people that will die early to help cross-subsidize. And if she dies early, vice versa. So their longevity risk is perfectly hedged. But the investment risk is locked up on day one, because they're basically buying bonds that exactly pay that amount for her life expectancy. And then that's it. They're done. They lock it up under bonds on day one. This is very unusual for charities to hear. If you look at the top 10 life insurance companies and their immediate annuity pools, they've got the law of large numbers, as I mentioned. They've got all kinds of very interesting investment opportunities that most mortal men don't have. They've got actuaries crawling over themselves, and they're trying to make one more penny per profit every single day they drive into work. What do you think their equity allocation is for these literally billion-dollar pools? It's 2.8% is the average. 2.8. The other 97% all fixed income investments. And they would look at you and say, well, why would you ever take equity risk when you've got a known fixed payout in the future? I'm not saying to go 100% equity, to be very clear. And all you have with a gift annuity is a horribly priced immediate annuity. Horribly priced. It's basically priced 30% too high. That's the gift. That's the gift. If you took that same $100,000 to any immediate annuity company, they will blow a gift annuity rate out of the water because you're not making a gift. So the point is, if you've got a 30-40% additional amount, the buffer, the gift portion, remember what I said the ACGA's methodology was? Is roughly a 40% equity, roughly 60% fixed. Do you start to see the methodology there? You also know that the charitable income tax deduction for most donors with gift annuities is about 30 to 40%. Do you see how all this is starting to lock up? That basically means that 60%-ish is what the life income liability is. So put 60% in fixed income, and all the rest, that should lock that up, assuming law of large numbers, which no charity has. But then you take the rest and kind of put that into equity or whatever you want to, at least theoretically. All your pools are different. I'm making kind of broad assumptions here. But I want you to kind of lock into this asset liability matching. What most charities do, most all of our clients are about 60 to 70% on the equity side. That worked beautifully in the 80s and the 90s. They're getting crushed now. And what most investment advisors, and some very good ones are on the phone right now, and you've all heard me drivel on about this, But when you look at a pension plan, when you look at a prepaid tuition plan, when you look at a lottery payout, when you look at immediate annuities, how all those are invested, all those are locking up the liability by concomitantly matching that with an asset to match that future known liability. That's what they do. What's the point? Most of these are invested like endowments. Most all of these charities are just flopping it into their endowments, and their endowment manager is managing it. Look, I don't know what's going to happen in the market today, next week, in the next 10 years. I'm clueless. But what I do know is that's weird. Why do I know that's weird? Tell me about endowment. What are the characteristics? Time horizon, perpetuity, forever. Liability on day one with an endowment gift, 0. The payout is your spending policy, which can be changed this afternoon at 3 o'clock by board resolution to 0 if you wanted to. Well, that's interesting. Those are interesting characteristics. You're really just trying to meet the spending policy. You're trying to do that under a total return methodology, and you're trying to have the assets and asset mix and diverse enough to be able to get you basically a rate of return, less expenses, less inflation that will spit out the spending policy. That's the game, right? Okay, let's jump over into the gift annuity world. Liability on day one, 60 to 70%. That's not 0, a little bit different. 2, payout, fixed as of date of contribution, can never change, and is mathematically constructed to eat into principal on every single payment. That's how you get down to 50%, because you're eating into principal on every single payment. Time horizon, 14 years on average, could be 3 years, could be 20 years. Do those sound different to you? They sound different to me in terms of how that's invested. This gets back to if you've got 70 or 80% on the equity side. We had one client, 80% equity, 20% fixed, and they're saying, gosh, our pool is just not performing well. Yeah, I know. Look what's happened since early 2000s. You can watch CNBC for 4 minutes and know you're probably getting popped. If you had the same thing in the 70s or the 80s and the 90s, we wouldn't be having this conversation. You wouldn't be able to figure out how to spend all the money. The point is you're really, really ratcheting up that risk profile for better or worse. And my very bad analogy is it's going back to that 16-year-old, let's pick a boy, that's even worse, 16-year-old boy, would you buy him a red Corvette? Would you buy him a red Corvette and let him go out on Friday night at 11 o'clock? Would you let him go out at 11 o'clock with 4 of his buddies somehow jammed into a 2-seat red Corvette with a bunch of beer? You're ratcheting up risk here to the point I don't think most charities understand the whip that can occur if they're off on these things. So anyway, relying on history to project the future, that's basically saying, hey, it used to be 100% as the residuum. I'm sure that will come back. I so hope we get a 14-year run with 21% returns every single year in the equity markets. Let's all hope that happens. But if that doesn't happen, thinking about what is not so recent history anymore, but it's something we still cling to, thinking it will snap back to some level of normalcy. The 80s and the 90s weren't normal, and let's certainly hope the last 10 years haven't been normal. So you got to be a little bit careful about just saying, oh, it's just going to come back to the way it used to be. How many gift annuities are you going to write, and how large will they be that could potentially do damage to the organization until you kind of get back to normalcy? 7, self-insuring large concentrated risks. What does that mean? Back when I talked about this retention limit or this deductible, same thing. If you're Harvard and you do one for $4 million and the whole thing blows up, who cares? That's BBs off a battleship, petty cash, done, move on. If you're the Montana SPCA, probably an issue. You got to understand where your risk tolerance is. One thing that also surprises people first is that only less than 3% of insurance assets for immediate annuities in their general account are equity. That's the first thing that people are like, that's interesting. We're a charity with no actuaries and 14 people in our pool, and we're 60% equity. The second thing is that of the top 10 largest insurance carriers in the country, if you called all 10 and you said, I've got an 87-year-old woman, and forget gift annuity, 87-year-old woman, she's got $1.3 million that she wants to give to you, insurance company, please solve for the amount that you would pay to her for an immediate annuity. If you called 10 companies, 7 would decline that gift, decline that business. This is not a gift annuity. This is just you're calling them to buy an immediate annuity. 7 would decline it. What's the key word? Decline. They wouldn't even give you an offer. The pricing actuaries for about 4 of them would not know how to price someone over age 85. They don't want to touch anybody older. huge longevity risk for anybody over age 85. So that's a decline. They wouldn't even say we're going to surcharge it. That's, I'm sorry, we don't want that business. We are not even going to bid. The other ones would say, well, we'll bid on somebody over age 85, but we are never going to go more than $1 million on any single life. So a number of the very good carriers, we work with about 16 of them, would just say, don't even call us if it's more than $1 million on one life. We will not bid it. So we have a policy against that. Do you kind of see where I'm going here? That charities are 60, 70% equity in some situations. Insurance companies are 3. Yes, charities have a big buffer of a gift in there, but that might take them up to 30 or 40, which then locks in right with what the ACJ methodology is, number 1. Number 2, charities to be clicking their heels, popping champagne into the parking lot to do a $1.5 million gift annuity, or a $4 million gift annuity, or an $8 million gift annuity. And insurance companies with millions of people in their pool say there's no possible way we can figure out how to price that ourselves at any profit level. We don't even want to touch it. It starts to make you think. Next, no written risk management plan. That's my point. I was at a conference, and Frank Minton gave another great presentation, and he went through and he said, you know, there was one that got into big trouble. This one gift. Lots of these gifts are doing well, but one got into big trouble, and I think it was a $4.5 million gift annuity, something like that. And everybody around my table was like, oh, wow, boy, that's way too big to take in. And I was probably a jerk and blunt. I'm like, come on. Every single person around this table would have taken that same gift. And then you ask the question, do any of you have a maximum gift size? Do any of you have a maximum gift policy? You should. That gets back to the risk management plan. On Gift PL and all the plan giving listservs, all everybody wants to know is what's the smallest gift you take in? What's the minimum size? What's the minimum age? I do not care about the minimum size. Nobody calls me saying, gosh, we're getting destroyed on this $5,200 gift annuity we did on this 57-year-old woman. We don't get calls like that. We get calls like, hey, we did this gift annuity. It's $1.3 million. We picked the wrong time to do it, and she just won the Hawaii Triathlon Senior Olympics for the 5th year in a row. She's 94. Now what? That's where you get burned. So you got to be real careful on your risk management plan, matching the risk tolerance and characteristics of the charity to know if it comes in and looks like X, we handle it this way. If it comes in and looks like Y, we handle it this way. You manage it. You manage it. No periodic pool review. Insurance companies typically will do that 2 to 3 times a week. Most charities will do that. They think they do it once a year through FASB. That is just laughable. But usually that might be once every week to every 2 weeks at the most. I'm sorry, once every year to 2 years at the most. And most of them are much longer than that. And finally, no proactivity on known issues. I'm not that old. I've been in this field for 17 years. And we talk with lots of charities about their gift annuity pools. They call us. And I will also say that it's called observation error in statistics. People don't call us going, wow, our surplus is brimming over the top. We can't figure out where to spend all this money. They don't call us for that. They call us when they're in trouble, or they think that they're in trouble. So that's called observation error. So we get this kind of weird view. But I'd also say, looking at roughly $2 billion in assets, that's about over 10% of all the gift annuities known in the whole field. It gives us a pretty good perspective. But I get the comments. They used to be funny. They're not so much anymore. I'm sorry. Well, all this stuff will blow up and I won't be around anymore. Or, oh, that's my retirement date. Tell us when the first one blows up. I'm tired of that. It's old. I kind of get it, I guess. Look, you've got a responsibility for your organization to manage and to steward the assets that have been provided to you in the best possible way. And if you know that there are issues are there, get your head up out of the sand. Don't be an ostrich about it. There are a number of things. You can call any one of our 100 clients at all to say, hey, did we have very specific things that we now know to do, very different ways to be able to handle the existing pool, going forward, et cetera. Go to other consultants, whatever. But don't just say, well, I hope the market will go up 200% every 6 months for the rest of my life and things can work out. This ostrich thing is an issue, and it's particularly pervasive in the charitable community, to be blunt. Whew! Okay, I'm getting fired up. All my lunch is kicking in. Okay, I'm going to go through this pretty quickly. Gift annuitants live forever. That's the whole theme of this. Interestingly, when you look at the 1990 IRS table, that's called the census table or the mortality table. Where's my little pointer? Here it is. Then you'd look at what the life expectancy is under that table for a 77-year-old female. It's 11.1 years. If you then said, well, I wonder what that would be under Annuity 2000, it's 12.7 years. Under the old ACGA life expectancy table, many of you might recall it used to be an 18-month setback, 1.5 year setback prior to the paper that we had put together. It would be 14 years, and according to our mortality study, it was 14.8 years, and that's why the ACGA at that time moved back the setback to 2 years. What have we just done? If you take a 77-year-old female with a $100,000 CGA and the same discount rate, that's the same rate that you're pulling it back to the present value to understand what your current liability is, that on day one, if they did a $100,000 gift annuity, and you use this 1990 IRS table, which is completely compliant for FASB purposes, now it's the 2000 census table, but it didn't move much at all, completely compliant, it would show a liability of $55,000 by changing nothing but the mortality table, which is plus or minus about 2%, it's dead on, that we had conducted, that's posted, and you can have real fun reading that, that actually increased her life by about 3.7 years, so from 14.8 down to 11.1, so that's 3.7 years. Doesn't seem like much, but that liability went up to $71,000. So the charities that will call us and they'll say, we're getting a little bit worried, Brian. We have $11 million in assets and $10 million in liabilities. The first question I ask is, what mortality table or life expectancy table are you using to calculate the liability? And 2/3 of the time, it's the census table, the 1990 table. So they are basically understating the liability by about 30%. Said another way, they thought they had $11 million in assets. They do. That's a hard number. They had calculated $10 million of liabilities by doing nothing but changing that mortality to the ACGA, in essence, life expectancy assumption. That $10 million of liability just jumped to $13 million. So they thought they had a $1 million buffer. Now they basically are underwater by about $2 million. This doesn't happen all the time, but you can see the swing, and you can also see the incredible confusion of business and finance staff where you might have some of these starting to exhaust, where they're saying, gosh, we keep running these numbers, and it's showing that we should have a really good surplus. The assumptions are wrong. They're flat out wrong. The 1990 census table, you might say, well, then why is that even used? That's the census. That is the entire population. They're unhealthy, healthy, birth to death, census. Gift annuitants, top 1/2% socioeconomic profile in this entire country, even if they can give away $10,000. They're doing it at an advanced age, at age 78. They probably haven't worked in coal mines, had good education, have good access to health care because of their socioeconomic status. And here's the biggie. They are taking out a gift annuity, a gift instrument that can only be based on their life expectancy. Are a whole lot of unhealthy people doing that? No. So what you're doing is you are basically, it's called adverse or anti-selection, is you are taking out of our wonderful herd of humans in this country, the whole population, the people voluntarily raising their hands to say, hey, I want one of those thingies, are the wealthiest, healthiest members of our herd. Do you think they probably have a different life expectancy? Yeah, they do, and that was the point. So just by making that change, you see how much that spikes. You also see how much the income tax deduction is overstated. So she's getting a huge income tax deduction because the IRS has her dying a whole lot sooner, almost 25% sooner, than she actually is expected to. So a real good deal for her. And you see their donors living 1 to 5 years beyond Annuity 2000. Okay. This is simply saying, well, how did this whole investment assumption work related to the ACGA? And it's not the ACGA's fault. They got no clue what's going to happen in the future. But you can see these just giant, giant swings, positive and negative, when you're trying to say we're assuming a constant rate of return. So let's just assume that the net rate of return was 5%, just to keep this easy. It's changed a whole lot over the years. The simple math here is just showing you where it's green. If it's 9.2% return in 1996, as an example, and you expected under the ACGA rates to have earned 5%, then obviously that is 4.2% better, green is good, better than what you had expected. If you would have gone back to about 1982, that would have been a green run like you couldn't believe. Green all the way back, pretty much. Beautiful run. But then you see what happened in 2000. It dropped 3.8% under, and so on. All of these are under. This is using the same asset allocation as the ACGA had at that time for their methodology. So you got lots of red since 2000. We know that because we know what's happened in the market. But this just lets you see how far off, which is very natural, how far off the reality is versus what was projected or assumed, and what the impact of that is for gift annuities. I think there have only been 2 years, looks like 2004, it was only 0.2 off the 5%. In 2007, it was about 34 basis points above the 5%. Those were the only two that even came close to matching a 5% return, and that was the, again, assumed average return of the ACGA over that time period. Okay, so now we talk about what is the risk. There are 12 different dimensions of risk. First is gender. We've done some projects where they're almost all female. Well, that's not good from a gender perspective because females kill us off very quickly and they live forever, et cetera. So if they're all female, versus we've done some, like a military academy as one example, where most all of them were male. Well, from a risk perspective, that's great because they do die sooner generally, and all things being equal, you'd like to have about a 50-50 split, all things being equal. For most charities, we see about 2/3 female and about 1/3 male. So gender is the first thing that we look at. The second are investment, and that is the average returns and the timing. Again, the average returns are real easy to calculate, but the timing of the returns are everything. I can show you very easily how you could get a 7% average rate of return for life expectancy and how that would exhaust. And all I would do is I would take negative 15% for the first 2 years, then I'd throw it up at about 13% positive all the rest of the time, and it would still go under. Conversely, I could show you how you could get a 0% rate of return and how you would have a huge surplus. And you just drive up the early years, you spike it 15% a year for the first couple of years, and then you drop it down to -5 all the way out, and you'll never sink it. Timing of the returns, people just do not understand how sensitive that is. Statistical, that's how many of these crazy things do you have? If you've got 14, you don't even do a statistical analysis on that. You really need to be at about 400 to 500 gift annuities before you're getting any kind of statistical significance, and even then it is weak. The largest charity has roughly 15,000 gift annuitants. We'd like to see 5,000 plus, where you could really start getting some kind of statistical significance there. That's the whole point of the predictability of law of large numbers. The problem there is to have perfect statistical predictability, you want what are called homogeneous units. So you want the same number of males and females coming in with roughly the same gift size, smoothed over time. That would get an actuary all excited. You can have 5,000, but let's say that 15 of those gift annuitants have $1 million plus gifts. Well, that just skews, that messes everything up. So now it's like I can predict which ones will die, but I can't figure out which ones of those from a residuum perspective, how that'll work out for the charity, because kind of so go those 15, so goes the whole pool, because all of the assets are so concentrated in that small group. So you have to try to find ways of collaring that up. 4, restrictions. So we talked about that a lot. Are these restricted? Community foundations, religious foundations, national social service organizations almost always are 100% restricted pools. Again, they'll never have a pool. All gains inure to the beneficiary organization, all losses inure to them. The charity's risk tolerance. We have had very interesting discussions with some charities that have said, look, we can never lose $1 on these ever. Our board is so skittish, our CFOs are going nuts, we can never lose $1 in any of these ever. I've got, I think, 2 of those clients on the phone right now. And basically, the only thing you can do there is reinsure all of them. And for all of those clients, we do not like doing that. That is, in our view, kind of overkill generally, unless they're all restricted funds that do that. But they've all been laughing at me the last 2 or 3 years saying it's worked out fantastic. But the point is, you just don't have to go that nuts the other way. That's like, I guess, 7 of our 112 clients. The other ones might say, you know what? we've got a big pool. We've got lots of reserve. Yes, we may have to go in to our endowment to take out some more reserve from time to time, but all of this is basically going to end up into our endowment anyway. These are more the unrestricted pools, which aren't a whole lot. So basically, we're just going to manage this like an endowment, which may make sense in that very unique set of circumstances. You know, we're good. And maybe anything over $1 million, maybe anything over $2 million, we want to kind of risk manage a bit more. But you know, it's going to be a pretty high level. Most of our clients basically say between 100,000, a lot around that 250. At that level or above, we want to start understanding better how to customize some risk management. So that's kind of where they're setting their retention limits. But everyone's very, very different. A number of ours have no upside maximum. 6, concentration. This is really big, especially for restricted fund charities, because a lot of times what we see are gift annuities like 40,000, 30,000. 60,000, 20,000, 1.7 million, 20,000, you're like, whoa, let's go back. Where did that 1.6 million slide in? So for a lot of charities, especially restricted funds, you'll have 1 or 2 giant ones. We had one, I guess 2 weeks ago now, a week and a half ago. I think they had 42 annuitants, and 2 of those annuitants represented 80% of their pool. 2. Well, you can do all kinds of statistical stuff. You can do all kinds of fun charts and math and all that. But tell me how long the 2 are going to live, and tell me what the investment performance is, and I'll tell you how your whole pool is going to work. Because if one of those 2 turn on you, they'll just bulldoze all the rest of them. If they do really well, you're just going to have monster surplus. But you've got a big tail to that thing. Again, that's getting back to, do you want to keep swinging for the, try to get the Eagles with the 3-wood or something. I'm not the worst golfer on earth. I don't know why I'm using golf analogies. But, or do you want to lay up and try to hit for the middle of the green and, just kind of try to shoot for a birdie on a good day and you'll be happy with a par kind of thing. So be real careful about the concentration risk. These are the calls we get. We do not get the calls on the small ones. We get the calls on the big ones that came in at the wrong time. And now we had one. It was a $6.5 million gift annuity, about a $280,000 a year payout. It's going to exhaust in about 8 or 9 months or so. To say the charity's freaking out is an understatement. I mean, they're basically saying this would be about half of our entire departmental budget. Now what? Well, they called us about 2 months ago. Sure would have been nice to have a little bit of warning on that. Back to my ostrich comment. They kind of knew that was coming. But the point is that the really big ones are the ones that can get you. The small ones don't worry about. Gift timing, number 7, gift timing. Very interesting in terms of what we observe. We typically create histograms for clients, and that simply just shows a bar by the number and assets that come in by year. And what you almost always see, this gets back to the kind of anti-selection or adverse selection as to timing, is when do all of the volume and all the big ones come in? The volume and the big ones almost always come in at the peak of the bull markets. That's when they have really big gain. They don't want to sell it themselves. They want to convert that basically risk capital or that equity investment into fixed, guaranteed life income, obviously, and to do that in a tax-advantaged way. They do that when the top starts getting a little bit bumpy on the bull market. They make the gift. What happens? That means you get this huge inflow of gifts at the top of bull markets. Is that when you want to be getting you want to be getting a lot of gifts? I'm with you. But it creates this weird timing dynamic where then you're taking this stuff in at the top. Also, the ACGA rates are almost always higher then because the economic rates and assumptions are higher relative to the 10-year bond, et cetera. So then you take all this stuff in at potentially higher rates, and then the bottom potentially drops out, like 2001, 2002, and then you usually have this very hard tail off on the size and volume of gift annuities. That's in almost every client situation we see. So you got to be real careful about the timing. You do not have to be a pension actuary to know if you wrote a whole lot of big ones in 1998, 1999, and 2000, that's just not good. If you did a whole lot of them in 1982, that's fantastic. So a lot of this gets back to when did they come in and the size when they came in. Gift flow. So you really want to make sure that you've got a good amount of new gift annuities coming in, good flow. Rate, that's basically what was the rate at the time you issued it. So it gets back to my point of saying in really good times, especially when bond markets are quite high in terms of the yields, that usually will push up those yields, and therefore that will concomitantly push up the ACGA suggested rates, generally based on the current methodology. So you just be a little bit careful about the rate risk in particular as it relates to smaller pools that you have, and again, back to restricted pools. Asset to liabilities, that's simply saying on a pool basis, how are your assets to liabilities using what we would consider much more accurate assumptions on the liability side, but then also on an individual gift annuity basis, which gets to exhaustion, which ones are underwater from an asset to liability perspective on an individual gift annuity basis, in particular for restricted funds. So then we look at the exhaustion probabilities for each one of the gift annuities independently. And then obviously longevity. Very interestingly, that if it is a healthcare charity, in many cases their longevity risk is lower because they were either survivors of that disease or malady and or were children of potential survivors. So therefore there might be some heredity issues there, unfortunately. But in many cases they have a slightly lower longevity than the rest of the group. For religious charities and for private schools, the wealth effect, and hopefully they're not sinning as much from the religious charities, they tend to live longer. So when we look at these longevity profiles, generally we're able to determine of that subgroup, are they going to live about average to the rest of gift annuities, which already live forever, or slightly less or slightly more. So it gets to the longevity risk of this specific charity too. So next, let's talk about this exhaustion frequency and severity. Gift annuities are great, and I want to take you through an example in a normal period going forward. We haven't had one of those in 30 years, but let's say one's coming before we all die. In a normal period, gift annuities have about a 6 to 12% chance of exhausting, of running out of money. Let's say it's on the higher end, just to keep the math simple. It's not that big of a deal. That's about 1 out of 10, 10%. 1 out of 10 would exhaust, which said another way, 9 out of 10 won't. 9 out of 10 will have a surplus. That's pretty good odds. And I'm even using the higher end of that range. The higher the exhaustion probability are for the older donors. And you'll see that in a moment too. Anyway, so you've got the exhaustion probability, let's say at 10%. So if you did 10 $50,000 gift annuities today, 9 of those would have residuum. Some could have really a lot over the 50%, some could have 50%, some could have lower, but only 1 of those would exhaust. Remember how I said the first thing you want to know is what's the probability of exhaustion, and now what's the severity. So now you'd say, well, what happens if that 1? Let's talk about that 1 now. If it does exhaust, how bad is it? What's the severity? And the cumulative payments that 1 exhaustion would amount to about 10 to 15% of the original gift. These are in normal periods. What does that mean? You write 10 at 50,000, 9 work out great, 1 goes under, goes to 0, and cumulatively makes payments of about $5,000 to $7,000 negative, 10 to 15%. But here's a key point. That $5,000 to $7,000 is in the future. Those are future dollars, which might mean $3,000 to $4,000 today. So you could write $500,000 of gift annuities, and you might have a $3,000 to $4,000 today, kind of at risk, if you will, or $4,000, $5,000, $7,000 at risk in the future. They're fine. You're fine. Where can you get in trouble? When things aren't normal, number 1, and or you don't write them all at 50,000. You write 9 at 50,000 and 1 at a million, and it just so happens that 1 at a million lives forever. Now you've got a problem. So the point is you got to be real careful about those large ones. The lowest risk by far is a young male with a deferred annuity. Most charities are petrified of these deferred annuities. They're great. You get scared because of the compounding rate. That's just a time value of money function. There's nothing else there. The good thing about deferred is you're not having to make payouts immediately into negative markets. So if 2008 occurs, you're okay. You've got multiple market periods to be able to catch that back up. And you also have, for a 55-year-old male or 60-year-old male, you might have a 30-year life expectancy. Probably a little bit shorter than that, but let's just say 30 years. What's the probability that person could live 35 years? Maybe 5, 10%. It's pretty good. But so what? That's about 10%, 15% longer. The highest risk by far is a 90-year-old female. Why? because basically the ACGA is setting to hit that 50% at her life expectancy. That might be 5 years. That's why the payout is so high. That might be 5 years. What's the probability she could live 10 years? Actually, about 10%. It's pretty good. That's 100% longer life expectancy. And when you're making 11, 12% payments out, I don't care what you're getting on the market. If she lives too long, that's a problem. So the oldest one, that's why, again, no insurance companies, or very few insurance companies, will even touch them at that age. But charities are writing them all day long, and they're writing big ones all day long. Finally, what I call the nasty math of negative compounding. This isn't fun, but I'm going to go through it quickly to prove a point. Let's assume that you wrote a 65-year-old female, $100,000 CGA, 6% on January 1st of 2008. I could have been a real jerk and made that October 1st, 2008, whatever. But I'm making just to make a point. January 1st, 2008, and assume a 60% equity, 40% bond allocation. That is the average charity that we work with out there. At the end of year one, I'm doing annual end-of-period payments. It could be bad and use quarterly payments, which would make this worse. So annual end-of-period payments, you have a loss on average of that pool, assuming index returns, of 25%. So you started off with $100,000. Now you have $75,000. And now you make the 6% payout. As you all know, that payout's based on that original gift. So that's $6,000. So now you have $69,000 left at the end of year one for this gift annuity. Now, 25% loss, I mean, again, that's beyond an outlier. That's an extreme. But I think you'll see my point here in a moment. She has a remaining life expectancy of 24.3 years. You cannot understand or comprehend how many charities we get now that will say, oh, yeah, but the market's coming way back, and I think we're going to be good. They don't understand negative compounding. The stock market return required in year two in 2009 to snap back to original ACGA expectations and assumptions to get you to that 50% residuum would be 70 to 80%, or a blended return of 51% to get you back up to where you should have been after that 1 year. And it's unfortunately a math problem where if you start at $100 and it drops to $50, that's a 50% loss. To go from $50 back up to $100, that's a 100% gain. The problem is if you go from $100 to $50 and you make a payout into that loss, now it's requiring about 120% gain to double it back up to get back up where you should have been. That's the problem with these beasts. If you would have done this in 2009, it's the opposite. You'll never think it because you had such a good year. You had about probably 14, 15% blended rate of return. That's fantastic. Here's the catch. Tell me what the next 24 months will be, and we can do perfect planning. Okay. Here are all the resources and articles. Have fun, 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 fun. I will back up and just give you some quick strategy. When the stuff comes in, and let's just say you set some retention limit that's relatively low. Let's make up. When we go back to this, 10% of these will exhaust. And some charities will say, well, how do we set a risk retention limit? I'll say, well, on this $50,000 one, if one goes under, and it goes under by about $5,000, can you make a $5,000 payment out of somewhere? And if they say, no way, we are not going to make a $5,000 payment out of somewhere, well, all of a sudden that becomes their retention limit or something lower, right? You just play this out. If you said, no, 5,000, who cares? We can come up with that in 2 minutes. Okay, how about 200,000? So now you might have 1 out of 10 that would have a $20,000 loss. Would that be okay? It's starting to hurt a little bit, but I think we could still do it. But we're getting touchy there. Okay, then let's do the risk retention limit at 250. So 250, anything over that, we're going to customize. Anything under that, we're going to handle in the normal way. What does customize mean? That might mean offering lower than ACGA rates. That might mean trying to tie that particular exhaustion back to another fund with a restricted charity. Hey, math department, we love you. We've done 20 gift annuities for you. But you know what? If one of these go under, we're going to go back to one of your funds to make these payments. So we're in this dynamic of all the wins are near to you, all the losses are near to us. That's not so fun. So we need to have this loss sharing agreement in some way. And or you can go back to donors and ask them to revoke a partial interest or a full interest in their life income. Lots of different ways to do that. Reinsurance is typically used only if all those other things do not work. So you want to look at all the other things first in particular the large ones, all things being equal, which they never are. Okay, so now you've got the resources here, all the articles, again, all linked. And finally, here are the random things we do. I think we've got about a minute left. Audits, I beat to death. Investment, management, and admin, already mentioned it. The reinsurance stuff, we work with about 85 charities, I guess, now around that. If you talk with, I'm going to be bad, if you talk with investment managers, I've never had an investment manager yet, I don't think, say, hey, we really think that there's something within this pool that needs to be reinsured. I've never had an insurance company say, hey, I think you could manage all this through investment allocation and other ways from the management side. So again, to be a little bit bad here, the insurance companies usually want to reinsure everything. The investment managers generally want to reinsure nothing. And quite clearly, there's some balance there. And usually it's just, where's the big stuff that can hurt us? Let's figure out some way of collaring that, et cetera. Gift annuity outsourcing, as I mentioned, the Decamai Foundation works in 42 states for gift annuities. Many community foundations on the call, many national organizations on the call today, and certainly many national religious organizations. You really want to go back to those groups that are very logical fits for you, both local, regional, or national, but this is a group. I would also say that Comerica Foundation does this, as well as Renaissance Foundation, too. And then we do some customized rate schedules. Most people always think that that's code for doing higher rates. In fact, it's kind of the opposite, where some charities have come to us and said, you know, we get the ACGA's models, make all the sense in the world, but for our risk tolerance and for our program, how would this rate schedule look if instead we said we don't want a 50% residuum, we want a 60% residuum or a 70% residuum, or rather than using the broad assumptions, which have to be broad from the ACGA for investment or expenses, could we not build in our investment assumptions and our expense assumptions with a different kind of residuum? We've done, I guess, 4 or 5 of these projects, and most all of those have actually had much lower rates than the ACGA. I'm not saying to deviate from ACGA rates, and you better have a real big pool to warrant that, frankly, but we're getting more of those kinds of questions because many of these charities are becoming obviously much more attuned to some of the risks that are in these pools. In my view, I'm just going to be real, again, blunt again, I wrote the first paper back in the late 90s. In the late 90s, the markets were up 20% a year, and people said, and these were friends of mine, hey, Brian, you need to get a life. Why did you just do a 20-page paper for the Journal of Gift Planning, talk about gift annuity risk, when the market the last 15 years has been up 20%, and in fact, the market the next 2 years was up 20%. The point was, I kept thinking it can't always be up 20%. That's just a wild guess, just like it can't always be down. The point is, charities were sloppy and lazy and ignorant, I will again affectionately say, around risk within these pools. It was a gnat. They were a small part of the assets. We'll just follow ACGA rates. Everything will work out. Let's not worry about it. Now, they're going way too far the other way. Risk is everywhere. Doom is, everybody's going to die. Everybody's going to get fired. Throttle back. You were doing nothing back in the 80s and the 90s, and now you're going so far the other way that you're trying to shut these programs down. In fact, from a risk standpoint, the worst possible thing you can do mathematically, the worse off a pool is, the more you got to get a whole lot of new ones in. CFOs love hearing that. But the point is they want to make sure that those coming in are not going to be a poison pill. There's not going to be another really big one that finds its way into the charity that 7 years down the road you're having the oops conversation again. So as long as they know it's managed well, we've never had one client shut their program down, makes no sense to do so. All of ours can be risk managed based on the characteristics of the charity and obviously of their pools too. So I've got 3:31. I went over a minute. I am sorry. I hope that this has been helpful. I hope it gives you some very practical ideas. I love gift annuities. I don't like the 16-year-old in the red Corvette with beer and a bunch of friends on 11 o'clock at night going out driving. Throttle back. Keep it in the fairway. Use more common sense. Know what risks you can retain. Know how you can reduce risk. Know how you can transfer risk. And know how you can avoid some things, too, to keep your charity in good shape, because the whole name of the game here is to maximize the net charitable revenue to your organization to further your mission, period. And gift annuities are a wonderful way and an incredibly popular way right now to do that. Thank you so much. This will all come out by slides later this afternoon or first thing tomorrow. And we will also have an audio link to this talk to the extent you want to forward it along to any friends and or colleagues. Thank you so much. And I do have a bunch of questions here. I promise I'll answer every one of these offline and get those to you later today. Thank you. Bye-bye.